After several years of tardy growth, a surge in the demand for residential property has led to an increase in real estate prices across the country. For example, prices of residential property in some micro markets in the top 8 cities rose by 15 to 20% in the 12 months ending 30th June this year. Delhi NCR saw the biggest jump in prices, with prices in Noida Extension and Greater Noida shooting up smartly. A 2 BHK house measuring 800 square foot could cost roughly around rupees 34 to 38 lakh, which makes the property affordable for the middle income group. Similarly, in Ahmedabad, an 800 square foot property in the most happening micro market will cost roughly around 40 to 48 lakh. So if you're planning to buy a house, we at Economic Times have come up with a checklist. So let's dive into it. The first one is, have you applied for a pre-approved loan?
Bank will give you a pre-approved loan basis your income level and your repayment capacity. If you have the assurance of a ready cash flow from the bank and a ready disbursal by the bank from the loan, you are able to strike a harder bargain with the seller. You will be able to negotiate better. So it's always better to have a pre-approved loan before you start your house buying plans. When you're going for a pre-approved loan, make sure you go through a loan aggregator who will help you get the best deal. However, make sure you don't apply for too many loans at one time, because it might impact your loan, your credit score.
The Real Estate Regulation Act is a landmark legislation that protects the right of the buyer and punishes the developer for delays, defects in structure, and other shortcomings. RERA ensures timely delivery by preventing the builder from channelizing funds to other projects. So another thing to look out for is whether the housing project is registered under RERA.
The RERA is certainly a very good law which safeguards the interests of the buyer, but don't depend completely on RERA. RERA, not all the projects are covered under RERA. So make sure that the project you are buying into is covered under RERA. This is for under construction projects. Of course, once the project is over and you're buying in a resale, there RERA will not apply.
One big dilemma for buyers is whether to pay more for a ready-to-move-in flat or book an under construction house at a lower price.
This dilemma is partly taken care of by the payment capacity of the buyer. Is he buying for immediate occupation? If you need a house right away and you want to avoid paying rent, then obviously you need to go in for a ready flat. But these are more expensive than an under construction property will be obviously cheaper, 15 to 20% cheaper than a ready property. But of course, you'll have to wait. It's always good to hire a property lawyer when you're going to buy a resale property. He will look at all the property papers and ensure that what you are buying is free of encumbrances. If you end up with a property which has problems at the back end, there are encumbrances, the property title is not clear, or there are claimants for that property, or there's a loan pending against it, then obviously you will face problems. Pay a small amount to a property lawyer. He will look at all the papers and ensure that what you are buying is actually free of any encumbrances.
Now, a lot of people don't know how much area they are buying when they book a flat. Builders try to hoodwink buyers by touting the super area of the project. You need to have a clear understanding of the super area, the built-up area, and the common area.
The super area includes all the common areas in the project. This will include your elevator shafts, your corridors, your lobby, even some other areas like staircases. Now, you're paying for that, you have to pay for that, yes, but don't count that as area that you will end up using exclusively. The super area, if the super area of the building of the property is 1000 square feet, the covered area that you will get to use exclusively is maybe only around 800 square feet. And out of this covered area, the covered area includes the walls, the area covered by the walls. Out of that, the carpet area, which is the area that you will actually use, which you will be free to walk on and use, is actually only 65% of the super area.
After you have taken care of the above, the big question is whether you can afford the EMI. There is a simple calculation that you should follow so as not to be buried under a mountain of debt.
Your total EMIs should not exceed more than 35% of your net monthly income. This includes all the other EMIs that you may already have, like a car loan or a personal loan or any other EMI that you have. You can stretch this and take it up to 50%, but beyond 50% is asking for trouble. Don't do that.
It is also a good idea to go for a short loan tenure as possible. If that's not immediately possible, make it a point to increase the EMI amount every year in the line with an increase in your income. This way you can prepay your loan fast and pay less overall. Another important question with regards to loan EMI is whether you should go for the fixed rate or the floating rate.
Interest rates are on the upswing and they have risen by almost 1 percentage point in the past 1 year. And as inflation is not showing any signs of slowdown, there is a possibility that the RBI may raise the rates further. That means that your EMIs will become costlier and your home loan rates will go up. Now, all companies also offer you fixed rate loans which will not get affected, where the interest rate will not change. These rates, these kind of loans are very attractive, it seems, but they also come at a slightly higher cost than a floating rate loan. A floating rate loan will be around 7.5%. At the same time, the fixed rate loan will be 1 percentage point higher at 8.5%. So keep in mind that when you're going in for a fixed rate loan, you will be paying a higher EMI than in a floating rate loan. Floating rate loan, the problem is that it may rise if interest rates go higher, which is a distinct possibility right now. But eventually, if you're looking at a 20-year loan or a 15-year loan, interest rates, as the economy improves and things get back to normal, this rate will come down. Also, when you're going in for a fixed rate loan, read the features very carefully. Some of these fixed rate loans are not really fixed rate loans. They are fixed only for 2 or 3 years. Beyond that, they automatically convert to a floating rate loan.
With almost 60 to 70% of the value of the property funded by the loan, you need to be ready for the unforeseen circumstances. Do you have a life insurance cover for the loan?
See, the past 2 years we've seen a lot of unfortunate cases where the breadwinner of the family passed away. And if they didn't have enough insurance, they faced a lot of troubles. These troubles are compounded if the property in which they are living in is funded by a loan taken by the breadwinner. It's always a good idea to take insurance to cover the loan when you're going in for a big ticket borrowing. If you've taken a 50 lakh rupee loan to buy a house, also take a 50 lakh rupee term insurance to cover that loan. If something happens to you, your family, your dependents will not be saddled with a huge liability to repay that loan.
Do tell us whether you like this video. Please give your opinion in the comment section. Keep watching this space for more such videos. Thanks for watching.